Warren Buffett famously said, "Be greedy when others are fearful." And this is exactly what's going to form the basis for this video. But before we proceed, I wanted to give a shout out to The Motley Fool for sponsoring this video. The Motley Fool provides investing insight and stock recommendations for investors of all skill sets and risk levels. So I'm excited to partner with the Motley Fool to bring you 10 stock picks from their stock advisor. Their average stock pick inside Stock Advisor is up 863% versus 173% for the S&P. Scan this QR code or check the link in the description to get your 10 stock picks right now. Now, I'm not going to just show you 3 random Magnificent 7 stocks and leave it at that. It's because being at the top of any sector isn't something that happens forever. Things change. It's as simple as that. One day you're at the top and next day you're not even in the running. And if you don't believe it, just look into the histories of companies like Blockbuster, Palm, and AOL stock. Now, before we get started, and just remember, I'm not a financial advisor and everything that I discuss here is for informational purposes only. Now, I'm sure you've heard of the Magnificent Seven before. If you haven't, this is a group of tech stocks that are famous for growth, performance, and they have significant influence in the stock market. In no particular order, they're Alphabet, Meta, Tesla, Amazon, Nvidia, Microsoft, and Apple. Now, you might be asking, what exactly does significant market influence mean? Well, it just means that they are big movers in the stock market. The Magnificent Seven's total market cap is actually 1/3 of the S&P 500's total. So any significant move from any of those 7 stocks will absolutely be felt across the entire S&P 500 index. And we all saw this during the 2024 bull run, where a company like Nvidia grew more than 170%. And of course, we see it right here as the S&P 500 entered correction territory when the Magnificent Seven collectively lost over $1.5 trillion in value. So why is that a good thing for us retail investors? Well, in my trading experience going all the way back to 1999, I have seen buying opportunities like what I think we have today. Actually, I think they come around about every few years. And because the Magnificent Seven stocks usually trade at a premium, to me, last week's correction seems to allow us an opportunity to buy some excellent names at a pretty big discount. There's also the fact that these companies have shown the ability to recover faster than most other sectors. So when the markets stabilize, these 7 are usually one of the first stocks to regain lost ground. But how do you pick which ones to buy? There's only 7 companies on the list. Sure, but diving into their financials, if you have to, well, it would take a long time. So for a quick shortcut, I'll look into what Wall Street thinks about the companies through their analyst ratings. Analysts are professionals who analyze companies from top to bottom, from their revenue streams to their debt management, and up to potential headwinds and tailwinds that they face across the broader economic landscape. Then they'll rate the stock on a scale of strong sell to strong buy based on how they think the company will perform in the next 12 months. For this analysis, I'll only take the ones that have a strong buy rating. And aside from giving the stock scores, analysts also provide a high target price. This is what they think the highest the stock price will go within the next year. They come up with these prices based on different valuation metrics. But of course, this is just potential guidance and not a sure thing. Still, Wall Street's approval and high price target gives me a lot of confidence about these stock picks. Next, I'll also check their year-to-date stock performance and see which ones have had the biggest price decrease. This way, I can identify companies that analysts are highly confident in, but have recently taken the biggest hit in their stock prices. A sharp decline in a well-rated stock could mean a temporary setback rather than a fundamental issue. So chances are these temporary setbacks mean excellent entry opportunities for you and me. And by the way, I did all this through bar chart. It's my favorite stock screener, and I use it to research the best stocks to buy every single day, and of course, to discuss in videos like this one. Their website gives you all of the basics for free, and all you need to do is create an account using this QR code right here. Now, let me show you really quick how I did this. First, I keep a watch list of the Magnificent Seven. So I can screen that and then add other things like analyst ratings, which I can set to strong buy, and then add the YTD percent change filter and leave it blank. Then when I run the screen, I can arrange the list from largest to smallest negative price movement change, and then I get my top 3. But of course, this is just the first step in stock research. The next step is to figure out why analysts love these companies, and if it's enough reason for you to buy them. So now let's move on to discussing why the top 3 on this list deserve a spot in your portfolio. First up on my list is Google's parent company, Alphabet. Now, we all know the search engine, which is widely used, kind of like a verb, right? That's how you know a company has made it. But did you know that Google has other business operations across the tech industry? Well, the company actually has 3 reportable segments. The first is Google Services, and this covers Android, Chrome, Search, Gmail, and other Google apps and services. The second is the Google Cloud segment, which provides infrastructure and platform services for AI development, cybersecurity, data and analytics, and so much more. And last is the Other Bets segment, and this covers the rest of the company's businesses. For example, self-driving cars, healthcare, and so on. So Alphabet's business is diversified, and it continues to grow and innovate to keep up with changes. Right now, Google stock has fallen nearly 13% year to date, but it still has a strong buy rating among 51 analyst scores and a high target price of $240. And that is a 45% potential upside. What do you think of a 45% potential upside? I think it's absolutely worth a like, don't you? Okay, so next up is Amazon, one of the world's largest e-commerce and cloud computing companies. It's actually a company that comes up a lot in my Discord channel because it's a stock folks often love to sell covered calls on. So what started as a small online bookstore that actually sells my book, The Financially Independent Millennial, has today turned into a giant in the tech field. These days, Amazon offers services ranging from streaming to cloud computing. The company also recently announced its commitment to developing and incorporating AI functionalities into its web service segment. Today, Amazon is undoubtedly a tech company, but its biggest moneymaker is still its online stores, which generated over $75 billion in revenue the last quarter alone. It leverages its massive logistics infrastructure to deliver goods fast, making it the preferred choice for this delivery-centric economy. Meanwhile, Amazon Web Services, or AWS, continues to grow as more and more businesses and clients use the platform for their digital needs. Actually, AWS is super simple to use for most businesses. Amazon stock, however, has fallen nearly 10% since the start of the year. And 50 analysts rate the stock a strong buy with a high target price of $306. And that's a near 55% upside. That's incredible. And last but definitely not least is NVIDIA. Now, here's an interesting story about NVIDIA's rise to the top. The company used to be known for high-quality graphics cards, which I used for gaming and productivity that required high computing power. And it didn't really have much competition in the space except maybe for AMD, but they never really quite matched NVIDIA, or at least what they could do. Anyway, going back to the pandemic and the crypto mining boom, miners bought out entire stores worth of NVIDIA cards for their rigs. It got so bad that some of my friends couldn't even buy single graphics cards for their PCs at the time. Now, do you know what else requires high computing power? AI platforms. So it was inevitable that NVIDIA would rise to the top of the tech sector because its hardware proved to be perfect for running and training AI models. Companies racing to develop AI applications, from chatbots to deep learning systems, now rely on NVIDIA's cutting-edge chips to power their innovations. NVIDIA stock has fallen roughly 9% year to date, and that gives investors a chance to snag up shares at a discount. And if you're not convinced, NVIDIA stock has a strong buy rating among 44 analysts and has an over 80% potential upside based on a $220 high target price. What do you think about $220 for NVIDIA? Let me know in the comments below. The Magnificent Seven present the kind of growth that most investors can only dream of. However, you do need to be mindful of your entry, and this $1 trillion or $1.5 trillion correction might just be your best opportunity. Still, remember that markets are fluid, so definitely do your research before hitting that buy button. And what do you think? Are any of these top stocks on your radar? Let me know in the comments below because I love to hear your thoughts and get back to you. And if you really enjoyed this video, don't forget to like, subscribe, and hit that notification bell so you never miss any of my future content on investing. Thank you so much for watching, and I'll see you in the next video.